marketplace and is very used a lot and very relied upon for CFD traders. Now, if you notice on your screen, I've put together two handouts for you. You can see the little buttons there to say download. Please download them now because they are not available in the recorded version of this class. So I've given you the ETS Capital Forex Strategies Guide, as well as the ETS Capital Technical Indicators Guide. So please download those on whatever device you're using, and then you can move them around and read them at a later time. Now, in tonight's class, I'm going to use the term security, but I might say the euro, I might say Facebook, I might say Google, I might say Bitcoin, but I'm not talking about any specific instrument. I'm talking about all publicly traded financial instruments in which a market exists. It just gets very, very boring saying security, security, security. Same thing when I'm going to intermix the terms investing and trading. Now, we know typically an investor takes a long-term position, while a trader takes a much shorter-term position. And since we're all here part of ETX, we're short-term traders. But I mix the terms investing and trading because, again, it gets very, very boring saying trading, trading, trading. Now, whenever I'm giving a live presentation or a private class or working with a client one-on-one, seems like the first question anybody asks me is, what should I buy today? What should I sell? What will the price be a little bit later? Now, wouldn't trading be easy if we knew the answers to these seemingly simple questions? But I don't have a crystal ball. I don't have a Ouija board, and neither does anybody else. So anybody who tells you, I can tell you what the price will be later today, I can tell you what's going to happen, I can tell you use this and use this, or use this scanner and this tool, and you'll never be wrong. Believe me, there's nothing, there's no indicator, there's no strategy, there's no anything that can tell you for sure where price is going to be, because price is the only thing that makes a determination of what it's doing. And it's made up of lots of human beings. So if you're attending tonight's class in the hopes that technical analysis, especially RSI, is going to tell you what to do, But if you're attending this webinar with the hopes that technical analysis and using RSI will improve your investing and trading, I've got good news for you, it will. But so will a well-prepared trading plan and improving your risk management tools. Risk management is ultimately the most important part of your trading. So RSI, or Relative Strength Index, is an oscillator. Okay, what's an oscillator? It is an indicator that bounces between a high and a low number. Okay, and Relative Strength Index is called a bounded oscillator because no matter what happens, its calculations will always come out between 0 and 100. Now, the Relative Strength Index is a momentum indicator developed by a technical analyst named Wells Wilder and was published in his book in 1978. So this is a indicator that's been around for 50 years. So it's withstood the test of the markets. It's withstood the change in the markets. It's withstood moving to the internet, faster trading. It's withstood, the creation of the Forex market to the CFD market to online trading. So we know it is a reliable indicator. So without going too deep into the workings of RSI, it is primarily used to identify overbought and oversold conditions when trading an instrument. RSI is placed on the bottom of your chart. Now, before we talk any more about RSI, we have to understand the terms of overbought and oversold. Okay. Now, overbought just means that the market has had momentum moving up and it's starting to lose that momentum. In other words, the price has climbed too high too quickly. It doesn't, an overbought market, an overbought indicator doesn't mean to sell that indicator. An overbought market can remain overbought. An overbought market can continue farther up in the indicator. For instance, Bitcoin, which trades in big numbers and is very erratic, can stay in an overbought territory for a long time. Oversold is just the reverse. Just because something reaches the oversold indication on the indicator doesn't mean to go out and buy. What it's telling you is there's a problem in the current trend or the current movement. So keep that in mind. Now, RSI needs to be combined with other indicators or other techniques to make a decision, but it will help warn you when something is happening. So remember, an oscillator is a technical tool we as traders use to give us the indications as to whether an instrument is overbought or oversold. We use these overbought and oversold extremes to see in which direction the price action will have momentum. Oscillators are typically used in conjunction with other technical analysis indicators to make trading decisions on entering trades. There are a few oscillators like RSI. We have ROC, we have MSI, we have stochastics. But tonight we're going to be talking only about RSI. Now, the calculation for RSI, and believe me, you'll never ever have to calculate it again. It's pretty easy. RSI is equal to 100 minus 100 divided by 1 plus RS. And RS is the relative strength. The relative strength is the average of so many days when the instrument closed up or closed down. Now here's the key. What's the average of X days? Well, you can set your indicator to the time period in which you wish to see. Shorter time period tells you it covers a shorter gap in time. Now, before we do the calculations though, let's go see what it looks like on a chart. So let me pop up a chart here for you. And here we're looking at XRP. And it doesn't matter what indicator we're looking at. I'm only using this because I've also got a triangle trading pattern set up here. But RSI is simply such a popular indicator. We simply click on indicators and it will drop the RSI on our chart. Now, RSI is bounded between a 0 line and a 100 line. But then it has its internal boundaries between 70 and 30. 70 and anything above 70 is considered overbought, and anything below 30 is considered oversold. So anything in the purple area right here, which we can consider no man's zone. It doesn't tell you much. Now we will keep an eye on the 50 level. The 50 level is only important as it tells us which side momentum is on, but that's it. So as you can see, we can look at price, and even though we've had a steady uptrend here, we can see a much stronger uptrend in the RSI, because RSI is only determined by the up days and the down days. Now, RSI, and you can see RSI never broke out of the dead man zone, never went into overbought territory, even though the indicator broke up, okay, but fell right back to its range, and then RSI continued downward. We can see here where we finally got the legitimate breakout from the triangle, RSI did continue downward. Prices then moved in a sideways pattern, but RSI continues to move up and down. So it doesn't duplicate the trend. Okay, what it does, it calculates the momentum of that current trend or that current price movement. So again, we simply go up to our indicator button, and I'll show you how to do this on the ETX Trader Pro platform in a second. And we drop RSI on here. We then go to our settings, and as you can see, we've got the upper band here. Standard combination for RSI. And I've got my RSI band set at on orange, only because I made it something easy for you to see in this class on your screen. But you set it however you want to set it and whatever you're comfortable with. Okay, then we go to our input screen. Now the standard length for RSI, or the standard lookback period, is 14 days or 14 periods, 14 candles. Okay, it is the standard prescribed time format for RSI. You can adjust it to a shorter length or a longer length. The shorter length will give you more false signals and more erratic signals. A longer length might miss some of the overbought and oversold conditions. So let's go back to my PowerPoint. Okay. To simplify the calculation explanation, it has been broken down to basic components. RS is the average gain and average loss. The RSI calculation is based on 14 periods, which is the default suggested by Wilder in his book. Losses are expressed as positive values, not negative values. The very first calculation for average gain and average loss are simple 14-period averages. So again, like I said, you'll never have to do the calculation, but you should understand it. So the first average gain equals the sum of gains over the past 14 periods divided by 14. And then the first average loss is the sum of losses over the last 14 periods divided by 14. Okay. So if the if the price had a gain over that period, we add those together and divide it by 14. So we take each price and each close, and if it was a gain, we add them together and divide by 14. We take the days or the periods that had losses, add those together and divide by 14. So the second and the subsequent calculation are based on the prior average and the current gain loss. Again, we take the average gain. That's the previous average gains, because once you've calculated the previous average, you don't have to go back and do it again. Times 13 plus the current gain divided by 14. The average loss is the previous average loss times 13 plus the current loss, which give you 14. So taking the prior value plus the current value is a smoothing technique similar to that used in calculating exponential moving averages. Because what it does is by taking the 13-period average and then adding the 14-period divided by 14, it gives more weight to the most current time period. This also means that RSI values become more accurate as the calculation period extends. Now, Wilder's formula normalizes RS and turns it into the oscillator that fluctuates between 0 and 100. In fact, a plot of the RS or the RSI looks identically the same. Now, the default lookback period for RSI is 14. And as I mentioned, you can adjust the settings. So if we were to adjust and decrease the sensitivity, okay, or increase it, so a 10-day RSI is more likely to reach overbought and oversold levels than a 20-day period, a 20-day RSI. The lookback parameters also depend on the security's volatility. So in other words, as I mentioned, Bitcoin, it's extremely volatile. and has big moves, sometimes we might want to stretch out that look back period. We should also be aware of the personality of each asset we're using RSI on, because some assets will tend to stay in or close to overbought territory all the time. Then assets like Bitcoin, because it's got big moves and high volatility, might stay at the 97, 98 range all the time. And once a calculation gets up to 97, 98, because it can't go past 100, you're not going to see that it keeps going farther and farther over into overbought. But an asset that has very low volume, that doesn't turn much, and even though it's trading upward, okay, would it be expected to have overbought and oversold indicators in lower zones? So remember, RSI is considered overbought when above 70 and oversold when below 30. These traditional levels can also be adjusted to better fit the security or analytic requirements. Raising overbought to 80 or lowering it oversold to 20 will reduce the number of overbought and oversold readings. Short-term traders sometimes use a 2-period RSI to look for overbought readings above 80 and oversold readings below 20. So let's go over and see how we would put RSI on our ETX Trader Pro platform, and then we'll come back and discuss what markets is best applied to and how to best apply it. So now that you know how to put RSI on the ETX Trader Pro platform, let's go back and talk about briefly what markets it works well in, and then we're going to talk about how to use it in your trading. So since RSI measures the relative strength of the underlying market, it's a technical tool that can be applied to nearly all markets. So RSI will work well for you in crypto, as well as it will work for you in share prices. It'll work well on indices, ETFs, and crypto. I mentioned crypto, as well as Forex and commodities. So it's for us a universal indicator, because everything you can get on the ETX Trader Pro platform, RSI will function very well with. Now, the other thing about RSI, it works very well in short-term markets. So, you know, a lot of indicators do not adjust well when you're using a 15-minute or a 5-minute chart. RSI works well for them. Okay. Now, remember, in a downtrend, RSI can remain oversold, and in an uptrend, RSI can remain overbought. So we use the center line to determine market direction. So remember when I drew the 50 line, well, actually, let's go back over to the price chart. So when I highlighted the 50 line, actually, let's go over to my trading chart. Okay. When I highlighted the 50 line here, we keep this in mind because it helps us see the direction of the momentum in the marketplace. So we want to stay in touch with the 70 line, the 20, while we keep an eye on the direction up or down at the 50 line. So let's talk a little bit of how we would use RSI to make some determinations, because RSI does not give us decisions. So RSI is used in a number of ways. 3 popular functions, and which we keep talking about, are the overbought and oversold levels. Then there's the RSI ranges, and then there's divergence. Now we're going to spend very little time mentioning divergence, because all indicators basically have divergence. Divergence is when their calculations move in the opposite direction of the price. Divergence is such a far out theory that you can almost find divergence anywhere, and it really tells you very little of anything. But often you'll hear people talking about, either on the news, in the headlines, at the pub, they'll be saying this stock is overbought, or WXYZ is oversold. They're usually, when they say that, are referring to the asset's RSI reading. When the RSI is above 70 or 80, if it is used as well, it shows a strong run higher in price, which may not be sustainable and therefore due for a correction. So this is what we want to keep in mind. This is a very good explanation. It shows a strong run higher in price, which may not be sustainable. Not that it isn't sustainable, not that it's going to collapse now. It's getting too heavy. So imagine if we shot a rocket into the sky or a firework up into the horizon. Now we know that that firework is eventually going to turn over and say a rocket and come back down to the ground. Now we can see when its movement or momentum upward it starts to wane, but it can still get carried up farther even though the momentum is slowing. Now it could hit a thermal pocket, it can get boosted by a gust of air and still continue up. That's why it is not a precise measurement to tell you to get out of the market or to get into the market. Unfortunately, it's not as easy as buying when the indicator moves below 30 or selling above 70. Some confirmation of change in direction is needed. So what we would look for is we want to allow price to cross below 30. Okay, so here's our 30 line. Let price cross below 30 and then rally back above it before buying. In other words, is it coming down to the 30 level? Okay. But we don't want to think about buying until it's come back in and moved above the 30 level, or the reverse is with the 70. Okay. We don't want to buy it when it's 70 climbing to 80 to 90. We might consider when it comes up and then retraces back into the deadband zone. But again, it's not a single standing indicator. It doesn't give you buy and sell or transaction signals. So this approach can work well in ranging markets when the price is swinging back and forth between overbought and oversold levels. If the asset that we're looking at doesn't quite reach the predefined levels of the 30 and 70, alternate levels can be used, such as 35 and 65. You have to see how that asset tends to move. When a buy is triggered, a stop is placed below the recent swing low. A sell signal is used to exit long trades or initiate short trades with the stop above the recent swing high. But you need to look for other things. You cannot use this alone. Okay, so you have to use it in conjunction with indecision candles, good combination. Chart patterns, good combination. Now, RSI also doesn't tell you how far an asset's going to move. It doesn't predict movement. So one problem with the strategy is the RSI may not provide an exit signal, in which case a winning trade may turn into a loser. For such occasion, having a price target or another exit method is needed. Each asset moves differently and therefore may have slightly different ranges. So you need to adjust your level depending on the asset. During a downtrend, a short sell if the price rallies above 65 and then drops below. Now, again, I don't like mentioning divergence. It happens. I have a hard time finding it, and I don't find it giving me any relative value. But you should be aware of it. RSI is also used to spot divergence. Bearish divergence is when the price is rising at the asset, but the RSI is falling. So as we can see here on this chart, price is moving in an uptrend, while RSI, the calculations are moving in a downtrend. It warns The price could soon correct lower since buying momentum is slowing. So does being above 70 or below the 30. Divergence is not a timing signal, as it can last a long time. Rather, divergence helps confirm other signals or lets traders know when the trend is almost over. I look at divergence as if I see it, it's just telling me the current trend is in trouble. That's all I get out of it. Bullish divergence is when the price is falling but the RSI is rising. It warns the price could soon move higher since selling momentum is slowing. Now, RSI has several limitations, as all indicators do. Since the indicator is showing momentum, as long as momentum remains strong, the indicator can stay in overbought or oversold territory for long periods of time. Therefore, price analysis and some other confirmation tool is needed to spot reversals. This is true with divergence also. While the RSI may be dropping and price rising, that doesn't mean the price will drop soon. The RSI is just showing that the price is moving higher at a slower pace. Now, RSI ranges can help confirm trends, but each stock or market will have to have slightly different levels. One stock may repeatedly move to 38 on pullbacks, while others may go to 33. Therefore, some adjustment is often necessary. Now, the level of 50 represents neutral market momentum and corresponds with the center line in oscillators such as MACD. In a term of market analysis and trading signals, RSI moving above the horizontal 30 reference level is viewed as a bullish indicator, while RSI moving below the horizontal 70 level is seen as a bearish indicator. So we have the indicator breaking above the 70, telling us it's overbought. When it falls back below the horizontal 70 reference level and back into what I call dead man zone, it's telling us that we now have bearish indications. So in other words, here in the gold circle, this tells us we've moved to overbought territory. Okay. It's not telling us the market's bearish. It's not telling everything except the market is overbought. It's too heavy. It doesn't tell us it's turning around at that moment. When RSI falls back, turns around, and comes back below the 70 level, that's telling us now that bearish momentum has set in. Now, Wilder suggests that divergence between an asset's price movement and the RSI oscillator can signal a potential reversal. The reasoning is that in these instances, directional momentum does not confirm price. As with overbought and oversold levels, divergence are more likely to give false signals in the context of a strong trend. Wilder outlines another important indicator of a potential price reversal called failure swings. A bullish failure swing forms when RSI moves below 70, falls down as below and rises back above 30, but then pulls back again. So in other words, it fell down, went through the dead man's line at 30, went down to 30, but then moved back into dead man's zone above the 30, and then failed to gain that bearish momentum and fell back down below that 30 line again. Okay. So we have two ways to look at this. We have the 30 line here. Price falls down, breaks the 30 line, bounces back above, comes up here and comes back in. The second way to look at this is price moves down below the 30 line, gains the bearish momentum, but can't break back through that 30 line again. It falls down. This is called a failure swing, and is complete when the RSI breaks its recent high. This breakout is interpreted as a bullish signal. A bearish swing forms when RSI moves above the 70. So, you know, they're just the reverse of each other. So as you can see here, in the gold circle, we broke above 70, fell back below the 70 level, and then tried to bounce back up and couldn't get that momentum and then fell back down. Okay, so what we have here is a bearish failure swing and confirms that we are in a bearish market. So as mentioned in the above interpretation of RSI, it's a more reliable indicator in a ranging market and can give misleading signals in a trending market. However, a modified interpretation of RSI can be used in a trending market. So remember, we want to think beyond the crossovers. When traders first learn about RSI and other oscillators, they tend to gravitate to overbought and oversold values. While these are intuitive points to enter in the market on retracements, this can be counterproductive in strong trending environments. RSI is considered a momentum oscillator, and this means extended trends can keep RSI overbought or oversold for a long period of time. So remember, keep in mind the over 70, the below 30, the 50 line, and keep in mind the failure swings, how price breaks out and then falls back in to the dead man zone and then bounces back out or falls down. And then the momentum swings when price or RSI breaks below 50 or above 50. Now, all oscillators have a center line, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different with a center line found in the middle at the reading of 50. Technical traders use the center line to show shifts in the trend. If RSI is above 50, momentum is considered up and traders can look for opportunities to buy into the market. A drop below 50 would indicate a development of a new bearish market trend. So keep that center line in line at all times. So the bottom line is RSI is popular because it has multiple uses. It is used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can help spot or confirm reversals via divergence. Like any technical analysis tool though, RSI is prone to providing false signals. Price analysis is still need to be important and determine if a trend is present. And then important RSI levels identified for that particular security. So understanding that these are basic rules, but knowing the personality of the asset you're trading is critically important. So again, thank you very much for joining us. Remember, ETX is a regulated platform, and we thank you for everything. This is our last class in August. Our new September classes are present. We have a new 3-week course coming up in September. So please make sure you join us for that 3-week course. We'll go over charting, we'll go over candlesticks, we'll go over indicators, and everything that falls in technical analysis. Because too many people think technical analysis is just about indicators. And we're going to cover the whole field of technical analysis. And we have some interesting other classes coming up in September. So we'll see you next month. And we've had a great summer together, and let's get ready for school season and upcoming holiday season. Thank you very much for joining us, and have a great weekend. Bye now.